Hello and welcome to a Minnesota Banking Minute. I'm Carla Bush with the Minnesota Bankers Association, and today I'm joined by Brian Easley with Haberfeld to discuss the impact and importance of core customer growth in any economic environment. As a result of the pandemic, a lot of banks have pushed the pause button on projects or strategic initiatives in the last few months. Brian, what are some of the impacts you saw in the last economic downturn? And what are some of the opportunities out there right now that banks can focus on to accelerate growth?
Yeah, well, thank you. We've, kind of gone back and collected a lot of data from the last financial crisis, 2007 to 2009 and beyond, to really get a picture of how customers impact a bank's overall performance, ROA and ROE, during and post the Great Recession. And obviously, the entire banking industry was challenged during that time. And I do think banks are better capitalized today during the pandemic than during the Great Recession. But regardless, those banks that had a continued customer growth strategy fared much better. Having more core customers, both on the consumer and the business side, is one of the best ways to guarantee strong performance in all economies. What we see with banks executing a consistent growth strategy year over year tend to have, on average, about 2,200 retail and business customers per branch, which is roughly double that of the average community bank. And those banks that had more core customers during the Great Recession saw, less of a decline in ROA, about 26% dip compared to the industry of about 56% of a decline during that time period as well. So, and ROE followed that same trend line. But just as important, those banks that stayed the course through the crisis, we also saw came back much stronger on the recovery side. So today, during the pandemic, as I said, I think banks are much healthier going into what we've experienced so far in 2020. We've all seen how community banks have stepped up to the plate with the Paycheck Protection Program. But when we talk about growth, that has obviously been one way to help secure your relationships with small business customers, but also an opportunity to gather new small business relationships. And it's not just through the PPP funding and now going through the forgiveness process, but to gather that entire relationship with business customers and their personal relationship as we kind of come through this. But it's not just on the business side, it's on the consumer side as well. One of the things we've learned over the years is you can't convince any consumer or business to change their bank. They're going to do that for reasons you can't control. It's so hard to switch today. But over the last few months, consumers and businesses, they've had more time. Banks have had more opportunity to capture that switch that's already happening in the market. So those folks that have stayed the course, focusing on welcoming many new relationships, continuing to have that growth focus, are significantly growing faster than those that may have taken the approach to hunker down.
Thank you so much, Brian. We all know that the pandemic is going to have a financial impact on community banks. What are some things that are going to help banks get through this as smoothly as possible?
Yeah, I think pure and simple, it's non-interest income. When we're in times with compressing margins, non-interest income becomes even more valuable. It provides a little bit of a cushion, if you will. As I said before, when looking at growth-oriented banks having twice as many customers per branch than the industry average, they simply have more non-interest income. So as the customer base increases, non-interest income grows with that as well. And it's not because, charging more fees or regular service charges, but, rather more customers using income-producing services such as, interchange income, or customers valuing overdraft services. You can't dramatically change the behaviors of your customers using their debit card. There are some strategies and things out there that folks do that can have a marginal impact per customer. But as you just have more customers that produce the average of what your current customers are producing today, and things like interchange and overdraft income, or certain fees that the customer sees value in, you make a lot more money. So, also customers bring more low-cost funding. And although, we're in times where borrowing is cheap, this does translate to improved net interest margins over time. So, what our data shows is the first product typically purchased at a bank on the consumer side, 70% of the time is a consumer checking account. and 55% of the time on the business side, a business checking account. And checking deposits are the lowest cost funding available. And I think the last thing I would say is, touch base on what we call relational intensity. Checking customers simply buy more products and services from their bank. They consider you their bank when they transact with you. So growing both retail and business checking customers gives your bank what we would say the first right of refusal on other products and services when those needs arise, both on the deposit and on the loan side.
Thanks so much, Brian. You've given us a lot to think about. We're out of time today, so thank you for joining us for another Minnesota Banking Minute.